February 3, 2026 is a date that will be etched into the memory of Wall Street. On that Tuesday, the Nasdaq Composite experienced a sudden and significant drop of 1.4% in a single session. This was not driven by inflation fears or Fed whispers. The catalyst was something far more fundamental. News of a new, remarkably capable AI tool rippled through trading desks. Traders and long-term investors saw a direct and immediate threat to business models. The morning had started with a deceptive calm. Markets opened to a steady stream of ordinary corporate news and macro data. Then the first reports began to surface on niche tech blogs and were amplified by major news outlets. They described a new AI platform released not by the familiar titans, but by a surprisingly agile competitor. This tool was capable of performing complex knowledge work. It could write sophisticated software code. It could manage complex corporate operations. It could handle nuanced customer service interactions with alarming efficiency and at a fraction of the current cost. For the better part of a decade, artificial intelligence was predominantly a spending story. Companies across every sector poured billions into building infrastructure for a future they believed was coming. They engaged in a costly arms race for top-tier talent, hiring legions of data scientists, machine learning engineers at exorbitant salaries. Balance sheets swelled with capital expenditures on powerful GPU chips, sprawling server farms. The line items for cloud computing, data acquisition grew quarter after quarter. This was the investment phase, a period of immense cash burn that investors largely tolerated, viewing it as a necessary toll on the road to future dominance. Many technology firms and some non-tech companies venturing into AI reported significant operating losses from these ambitious projects. The prevailing wisdom on Wall Street was patience. Analysts and fund managers accepted the red ink, modeling it as a long-term investment in research and development. The logic was simple. The companies that spent the most today would build the most powerful AI systems, and those systems would eventually generate immense profits tomorrow. It was a story of spend now, profit later, and stock prices reflected that forward-looking sentiment. Then, the event of February 3rd signaled the later had arrived. The new AI tool wasn't incremental. It was a commercial-grade platform offering an immediate path to profitability and disruption. It proved the technology had crossed a critical threshold. For an adopting firm, the value proposition was undeniable. They could automate tasks that once required entire departments, leading to dramatic, rapid cost reductions. They could leverage AI to create and deploy new services at scale and speed, opening entirely new revenue streams. This marks a monumental shift in the AI narrative. The technology has transitioned from a capital-intensive research project to a powerful, profit-generating commercial engine. It has moved from being a cost center to a core driver of financial performance. The trading day itself was a masterclass in market psychology, revealing how quickly sentiment can pivot in the face of paradigm-shifting news. We witnessed a clear and brutal bifurcation in the technology sector. The stocks of some established tech giants fell sharply. A handful of cloud computing companies surged. Nimble software firms also saw big gains. The volatility was extreme. Small, specialized firms rumored to be involved experienced wild price swings. On trading floors around the world and in home offices, the human element of this technological event was palpable. Faces of traders, illuminated by the glow of their multi-screen setups, showed intense concentration. Charts were analyzed with a new urgency. News feeds were scoured for any scrap of information. The market was moving not just on data, but on a powerful cocktail of fear and opportunity. Fear of being left behind. Fear of holding assets that were becoming obsolete. This event extended into a deep-seated human anxiety about the future of work. Software developers began to question the long-term security of their roles. Content creators began to question their future. Administrative support workers faced uncertainty as well. Corporate managers had to weigh massive new tech investments against potential workforce displacement. For individual investors, the gyrations raised real concerns about retirement savings and long-term plans. This AI tool didn't just move stock prices, it altered the collective perception of the future. The velocity of the stock movements showed how quickly AI-driven change can unfold. Unlike past shifts that took years, this software could be deployed globally almost overnight. So, why did the market react with such force and immediacy? The answer can be broken down into three primary factors. The first, and perhaps most critical, is the concept of scalability. Unlike a physical product that requires factories, supply chains, and logistics, a sophisticated AI tool is fundamentally just software. Once developed, it can be replicated and distributed to millions of users at a near zero marginal cost. This allows a single superior system to serve a vast global market almost instantaneously, creating a winner-take-all dynamic that the market was quick to recognize and price into the affected stocks. The second factor is the direct and measurable impact on profitability. The new AI platform was not a vague promise of future efficiency. It offered a clear, quantifiable path to cutting a company's largest expense: payroll. At the same time, it enabled the creation of new, high-margin revenue streams that were previously impossible. When a single innovation can simultaneously and dramatically reduce costs while opening up new markets, its effect on a company's bottom line is exponential. Investors understood this equation and swiftly sold off shares in companies with bloated cost structures and rewarded those positioned to capitalize on this new operational leverage. The third crucial factor is the inherent uncertainty that such a disruption creates. Traditional financial models are built to forecast earnings based on historical trends and predictable growth patterns. They are not well equipped to price in a technological earthquake of this magnitude. When a truly novel and powerful force emerges, these models break down. In the absence of a reliable framework for valuation, the market becomes highly sensitive to news and sentiment. The appearance of a clear leader in a new, transformative category forces a rapid and often chaotic repricing of all related assets as traders abandon old assumptions and rush to establish a new equilibrium. In the wake of this market shock, what should a prudent investor do now? The first and most critical step is to resist panic and commit to education. This means moving beyond the headlines and learning to distinguish between hype and reality. Focus on identifying the companies that are using AI to generate tangible, sustainable profits, not just press releases. Scrutinize quarterly reports, listen to earnings calls, and, where possible, look at product demonstrations. The key is to understand which firms have a clear strategy and a defensible moat, and which are simply riding a wave of speculation. Arming yourself with facts is the best defense against market volatility. Second, it is essential to maintain a long-term perspective. Financial markets are notoriously short-sighted, often overreacting to both good and bad news. While the AI-driven disruption is real and significant, the transformation of entire industries takes time. True business value is built over years, not in a single trading session. Therefore, investors should focus on identifying fundamentally sound companies with strong balance sheets, competent management, and a clear path to integrating new technologies for lasting growth. Avoid chasing short-term momentum and instead invest in the durable, long-term winners of this technological shift. Third, disciplined risk management is more important than ever. The speed and scale of AI-driven change introduces a new level of uncertainty into the market. This is not the time to make concentrated, all-or-nothing bets on a single, unproven technology. A well-diversified portfolio, spread across different asset classes and geographies, remains a cornerstone of sound investing. Consider using tools like stop-loss orders to protect against severe downturns. Participate in the upside of the AI revolution, while ensuring your portfolio can withstand inevitable shocks. The future can arrive faster than anyone expects, and it demands diligence and foresight. This move signals a new chapter where technology reshapes markets with unprecedented speed. Subscribe to Practical Wealth Advisor for clear, calm guidance on wealth management in the AI era. Learn how to protect and grow your capital as this powerful new force reshapes our world. Stock valuations that were once based on the promise of future earnings must now be re-evaluated based on current and near-term disruptive potential. The stocks of companies clinging to old, labor-intensive models are now exposed to significant risk, while those at the forefront of this new wave of AI deployment are positioned for rapid appreciation. The market's reaction was almost instantaneous. Investors began to do the math. For companies that integrated the tech, the path to dramatically higher profits opened. They could slash operational expenses and scale services at a speed previously thought impossible. Conversely, many companies reliant on large human workforces or older software looked vulnerable. Their competitive moats appeared to shrink in a matter of hours. The Nasdaq's sharp decline was the market pricing in this disruptive reality. What transpired was a classic wake-up call, delivered with cold algorithmic precision. For years, AI was framed as future potential and distant reward. On February 3rd, the future arrived ahead of schedule. The abstract threat became a tangible market event, creating and destroying shareholder value. The day's trading was an acknowledgement that valuation rules in the digital age had been profoundly and irrevocably altered. For corporate leaders and boards of directors, the choices have become stark and urgent. The strategy of waiting and observing is no longer viable. Companies must now choose to adopt powerful new tools to enhance operations, or risk being outmaneuvered by more agile competitors. This means hard choices on capital allocation, workforce training, and business strategy. The winners will move decisively, integrating AI to deliver real value and measurable results. The losers will cling to legacy systems and face eroding market share.